Hello and welcome. I'm Kavita Thapliyal, and we have for you a very special programming today to understand how the real estate sector is shaping up across the country. The real estate sector has witnessed significant boom recently. In fact, demand for residential units was up 7% the previous quarter. Now, what is driving this demand, and can we expect this growth to sustain going forward? How is affordability in residential housing segment expected to change? And penciling in current inflationary conditions, current property prices and rental yields, should an individual consider renting or buying a new home? What kind of financial discipline should one incorporate for their dream home? Also, when we consider real estate as investment, how much should we bucket out for REIT? So let's deep dive, and to discuss all of this and more today, I have a panelist of, I have almost the best of the industry panelists. In fact, I have with me Ashwin, Patni, Head Products and Alternatives, Access AMC, Preeti, Chheda, Executive Committee Member, Indian REITs Association and CFO, Mindspace Business Parks REITs, and Preeti, Rathi, Gupta, Founder and MD, LXME. Good evening and welcome to the show. And thank you so much for giving us your time today and helping our viewers, in fact, understand every aspect of, investing in real estate, be it through REITs or buying a house for their own self-consumption, or maybe, even renting it out. So let me just begin with one very basic question, and I'm going to ask this same question to all three of you, and I'll start with Preeti Gupta. So Preeti, when did you buy your first home, and was it an investment plan that you had opted for before you buy, or it was obviously like how all of us do, actually, loaning it out? How was it?
So Kavita, actually, my first house I bought much later, when I came into my late 30s. And the reason was, I think, coming from financial services, just understanding, when is a good time to buy your first house. And then, of course, bought it, I took a home loan to buy the house, because that also makes a lot of financial sense, actually.
Exactly. Ashwin, what about you?
I bought my first house when I was 25, 26. It was for my own, so it was not really an investment. I have not really invested in a house in my life.
After that, okay. Preeti Chheda?
Yeah, hi. So, of course, I did my first house investment at the early stages of my career in late 20s. And being a part of real estate, any which ways, I'm very fond of real estate as an asset class because it has its own benefit in your overall portfolio allocation.
Exactly. So, a lot of Indians, just like you, must have bought their houses. I mean, when you have the first salary, when you get the first salary, the very first financial goal that one is told to set up for themselves is to buy a house. Even before you think about any other financial goal, having a house of your own, it's not only a mindset issue, but, a lot of things actually are attached to when you say that you own a house, and especially the kind of status you have in the society. So, any which ways, let's take the conversation ahead and let's talk about investing in real estate, buying your own house, or maybe just living on rent. So, Preeti Gupta, again, I'll start with you, because lately we've seen a trend that's catching up, and the trend is about instead of owning your property, okay, not talking about having second homes or a farmhouse, etc. Even the first home that you want to buy, it's not needed anymore. In fact, a lot of people, especially millennials, and especially millennials who are into the FIRE concept of, financial strategy, believe that renting it out, or maybe living on rent all your life, you are getting the financial freedom you want. You are not paying EMI, so in some way you have that cash in your hand, and maybe you are financially much more stable, rather than buying a house and then you've got to pay the loan for like next 20-25 years, and in fact you're even tied up to a particular job. And looking at the trends, or the kind of lifestyles that we are seeing, which is changing between, among millennials these days. They want to retire early, they want to have less liabilities. When we talk about owning a house, do you think this kind of a trend is here to catch up? And is it really financially viable and the right decision to maybe just live on rent and not buy a house?
So, Kavita, you're absolutely right. I think the trend is changing. I think the times that we came from, and like rightly, it was said, the minute you got a job, your parents would tell you, now the next thing is get married and get a house, right? I think those times have changed. We see that complete mind shift. I think the new generation, the millennials as well as the Gen Z, I think this sense of security also comes from a very different place of, it comes from a different place. For us, having a house, just say, like we used to say, chhat hai ghar ke, sar ke upar, that, or investing in gold, things that were tangible, was what we always put our money in back then, right? Now the world has changed. I think the youngsters, obviously, they are very, very savvy, financially also savvy. And I think from the mindset perspective, they no longer feel attached to saying that I need a home to live in, because it gives them the freedom of really living in different places, whether it be because of work, etc. So I think that need has definitely gone down, and that shift is very, very visible. But I wouldn't say that that shift has happened across the board, because it's still a very urban concept. I still feel that in tier 2, tier 3 towns, there is still, that concept of saying the first thing that you need to do once you start earning is to buy a house. Of course, I have my views on when this should be done, because a financially wise decision to buy your house is actually when you have a steady income. You've made sure that all your critical goals, like your emergency fund, retirement fund, all of these are in place. And that you have no other large debts. For example, if you have still a very, education cost a debt that you're paying off, or any other debt that you're paying off, not a great idea to take on the home, the home loan and start putting in the EMIs as well, right? And also, I think it's very important to understand that when you buy a home, you need to actually put in a down payment. And that's a very large sum. It's almost 10 to 20% of the cost of the house. So do you have the ability to really take that on? I think those are very important considerations to make before you get into the decision to go in and buy a house. And the next thing is, very important thing is that wherever you're buying your house, is that where you're going to live for the next, many, many years of your life. So I think all these factors are very, very important. Also, I believe that it's very important to create a good credit history, a credit score, so that actually when you opt for a home loan, you actually get great rates as well. So financially, I always think that which is why I bought my first home much later in life, when I realized that I don't have too many liabilities now, and it's a good time to take on this high EMI.
Exactly. I think that is a very important factor to consider whenever you are wanting to do such a huge amount of investment. But also a very important point that you highlighted, Preeti, living on rent is a very urban concept. And Ashwin, we've seen this also. I think during the pandemic, or even post that, we have seen tier 2 and tier 3 towns actually picking up in terms of residential buying, because people were working from home. They felt the need to have bigger spaces, in fact, a separate office space in their house also. Now, having said that, people are buying home, that is perfectly fine. But then we also have to consider that we have an old tax regime and a new tax regime, okay? A lot of us, for a lot of Indians actually getting that tax benefit as per the old tax regime, 80C on their home loan is a huge relief, which might not happen going ahead, because, we've seen 80 to 85% of onboarding already being done in the new tax regime. How big a factor is this, Ashwin, and how can we play around it? And especially looking at the rate cut scenario now approaching, we'll get the announcements done, and after that even RBI would be clearing their stance or their strategy as far as rate cut is concerned. How can one approach this to buy a house?
So clearly this has been a long-standing part of our country, where people were encouraged to buy a house, and essentially this tax relief that they were getting on their mortgages brought down their their overall burden and made it easier to buy a house. I think it was a great move for all these years, because it allowed a lot of people to participate in this asset class and create, secure their own sort of homes for themselves. going forward, I mean, not to get into the merits, demerits of making those changes, but the reality is that effectively the cost of borrowing then goes up because the tax relief, if it's not going to be there, then it becomes quite important that what the borrowing rates are and what is the cost that as a borrower you have to incur to be able to take a home loan while you are doing the calculation in terms of your overall house cost and your house ownership maths. So what Preeti was mentioning just now, it becomes even more important that you're careful in terms of doing this calculation in terms of the affordability, in terms of your ability to pay down the loan, and the overall cost benefit analysis before deciding to buy the house. So yes, this at the margin will make it a little bit, the interest rate cost goes up, and that is something that needs to be factored in into the decision making for people.
Sure, sure. Preeti, Chheda, roti, kapda, makan. Very important factors that we've been taught since childhood, and real estate or your own property is also looked at a very important aspect of your retirement planning. Okay, if someone living in Bombay has a property where they live and has a second home in Bombay, or maybe more than 2 houses in Bombay, they are considered to have their retirement set. In fact, life is set for them. Okay, I want you to help us understand rental income for your retirement. Still, for a lot of Indians, is a very crucial aspect of their regular income after retirement. That time when they do not have any regular income from any of their investments, or maybe if they've just invested in fixed income, they depend heavily on a real estate income, rental income. Now, that and investing in REITs, okay, for your regular income after retirement. How would you like to explain us the difference and which is better and why?
So REITs, which are real estate investment trust, exactly address the issue which you spoke of. So these are vehicles which house income producing assets. Under the REIT regulations, at least 80% of the portfolio needs to be income generating, and at least 90% of the net distributable cash flows have to be distributed on a half yearly basis, while most of the REITs do every quarter. So essentially what it is doing is, instead of actually owning a physical asset, which you then rent out, you are actually now having liquid instruments which are easily tradable on the stock exchanges. Any moment you decide to buy, to sell, you have an open market where you have the option to buy or sell. And at the same time, you are getting returns on a consistent basis. Now, obviously, when you're owning a commercial asset, there are quite a few things which you need to manage. Like, for example, you need to take care of leasing that place. You need to ensure that the rentals are coming in time. Every time a tenant is moving out, you need to worry about having the next tenant. You need to take care of the maintenance of the house. So there are various challenges when you're actually owning a physical asset. And especially when you're talking about retirement, you don't really want to spend your time worrying about an asset and leasing and maintaining. As against that, I would say REITs give an alternative to owning a physical commercial asset. You can actually own an asset through these instruments, which are tradable, and you can continue to get returns both in form of yield, which is coming to you every quarter. So you get distribution, and you also get capital appreciation, because as the value of the property goes up, the price of your stock also goes up. So you are getting the best of both worlds. So you get regular income as well as capital appreciation. So I think these are perfect product if somebody is looking for getting retired income, consistent income on retirement.
Ashwin, let's also talk about having REITs as a part of a multi-asset allocation fund. There are very few MAF funds that offer REITs or InvITs, but then having said that, because MAF is multi-asset allocation, you do have an exposure that is given via this particular fund mix, a product category. So should we be looking at REITs separately as an investment instrument in a portfolio, or should we really opt for it as a part of your multi-asset allocation fund?
The interesting thing is that this is a very different asset class. Even though it is traded and listed and traded in the stock exchange, and in that sense represents or looks like another stock, the reality is, as Preeti was explaining, that this is a very different asset class. It's essentially you're buying a real estate in this, and the trends that affect a real estate and the rental yields of these things work very differently from, let's say, how a typical stock return is or a typical bond returns are. And these things also come out when you look at the correlations. The correlation between the performance or your total return of owning a REIT will be very different from the correlation will be very low compared to correlation of holding a stock portfolio or a bond portfolio. And that's where asset allocation comes in the picture, because asset allocation benefits from allocating to different asset classes which work in different cycles or have lower correlations with each other. Whether it is through a common fund like a multi-asset fund, or even if an investor is creating their own portfolio individually, having allocations to different asset classes helps create a better risk return and an overall better experience. And that's where REIT can play a very important role. To your point, yes, definitely investors should consider, REITs as a part of this asset allocation process. You mentioned that currently only a few funds have allocated, but I think that's just a journey. I think more and more funds are looking at REITs, and the allocations are going up over time. This is a very recent asset class. Even now, only in the last 3 or 4 years, we've started having REITs really available in India. So it's a journey for all of us. So I have no doubt that for most mutual funds, that allocation to REITs will start becoming an important part of their asset allocation kind of strategies. We are looking at it as well in Axis. So to your point, investors, depending on how well they understand these things and how much time they have on their hands to do these things individually, can choose to either do it on their own and buy these individually, or rely on asset allocation funds which allocate into them and give them an exposure to them.
Sure. Preeti Gupta, do you like REITs as a part of investment in real estate, or do you like multi-asset allocation fund and their exposure in REITs?
So I think, first of all, I am a huge mutual fund proponent. Like, when I go and invest, when I even advise all our women on the LXME platform, it's always through mutual funds. So only because you have an expert fund manager who's taking that decision. And particularly, I like the fact that REITs can play an important role in your asset allocation. However, I still feel that we are very early in this journey. There is time to go till we have, because if you look at, say, from 2019, maybe when the REITs were started to now, you look at returns ranging from, maybe a 2.5% to 10%. And yet the awareness, the liquidity, all of that, I think will take time to grow. And it could at some point form your strategy for retirement when it gives you consistent returns. However, I would still park it. I would park that decision a few years down the line and not today. And today, if I have to take a view, or if I have to get an exposure to a REIT, it would ideally be through a multi-asset allocation fund and not directly. And I do have a very strong view, Kavita, on the fact that when somebody looks at retirement, even today, if you look at, I know we're talking about real estate, but even today, if you talk about equity versus real estate, if you were to actually do a decent amount of SIPs, and even if you did say 15,000 rupees a month over 30 years, you could have a valuable corpus which you moved into a SWP, a systematic withdrawal plan. You could actually, that could be a brilliant retirement plan, and yet have your money growing. So even today, I'm a huge proponent of this method of creating a retirement plan versus saying invest in REITs or real estate, because that does come with, two things to pay attention to. One, what has been the return over the last 20 years in real estate, versus also what has been the regular income or the return that has come in via REITs, which could be, a rental income or a yield that has come in. So to me, those two, till they do not match up or come close to equity returns, I would not put them as retirement, but I would definitely look at REITs for some sort of asset allocation, because it allows you to enter with small amounts.
Sure. So, Preeti, Chheda, let's understand REITs over here. As we all know, very early stages, I think we have 3 to 4 REITs right now in the country, and definitely a very low awareness level also. So, just give us a masterclass kind of a thing, as to how much can we invest in REITs, what's the minimum amount of investment, where does our money go, what should be our return expectation. When we're talking about REITs, we just have commercial properties right now. What kind of properties are we talking about? So, just give us an idea, or just help the investors understand, if at all they want to put in their money, for what time horizon and what should be the yields expectations.
Right. So if you look at REITs, essentially, if I were to start with the asset class in which they're investing, today you have 4 REITs in India, of which 3 are office REITs. So essentially, they've invested in office as an asset class, and you have 1 REIT which is invested in malls. So you do have a mix of asset classes if you wish to choose which one you want to go with. There are multiple other asset classes which are available globally, which over a period could come into REITs in India. It could be data centers, industrial, student housing, so on and so forth. Now, if I were to take a step back, if you look at the history of REITs, they started in 1960s in the US. Today, globally, we have more than 1,000 REITs with market cap of over $2 trillion US. So that's the kind of REIT market that you see internationally. I agree it's early days for REITs in India, but I think the kind of success REITs have seen in a short period. The first REIT came in 2019. And today we already have almost more than 80,000 crore of market cap, more than 140,000 crore of assets under management. So I think it's a good success which REITs have achieved in this short span. If I were to look at the return profile, now obviously first you can buy a single unit of REIT. SEBI had reduced the lot size just to 1 unit. So it's as small an investment of say 200, 300, 400 bucks, depending on what each REIT is trading at. So you can actually go ahead and buy just 1 unit from the stock exchanges. And it's pretty liquid for retail investors to buy. Of course, when you're looking at institutional liquidity, being a new instruments, obviously it will take a while for the liquidity to improve. But I think from a retail investors who are going to buy smaller lots, I don't think liquidity is an issue. Coming to the return profile, so as I said, under the SEBI regulations, 80% of the portfolio needs to comprise of completed and rent-generating assets. So to that extent, I think it's an instrument with very moderate level of risk return, because the underlying contracts, especially if you look at office contracts, are almost 9 to 10-year contracts. Most of your contracts are with MNCs. So there's huge amount of certainty of cash flows. So if I were to again look at the COVID times where you were facing the most challenges, even in that scenario, almost 99% of the rentals were received by all the REITs. Of course, you saw occupancies dropping as compared to what it was pre-COVID level, but still it was healthy occupancy still, despite the headwinds which office sector was facing. So to that extent, these products are viewed as moderate risk and moderate return, of course. Now, even when you talk about return profile, I'd mentioned earlier, you have 2 forms of returns coming to you. One is in form of regular distribution yield. So the REITs distribute dividends on a quarterly basis, while the regulation mandates half-yearly. Most of the REITs are distributing on a quarterly basis. So you get an annual return of about 6 to 7 by way of distribution yield. And we've also seen appreciation in the unit price. And that's when I said you are getting a combination of distribution yield as well as return on account of capital appreciation. The REITs on an average so far have given almost, I would say, between 11 and 12% return, despite most of the, I would say, time since listing has gone during the COVID period. And I think the beauty of these instruments is, even internationally as well as in India, you have single level of taxation, which is benefiting this product because the distributions which come to investors are in 3 forms. So one is, say, dividend, which are completely tax-free. So today, if you were to receive dividend from a listed company, that's fully taxed. Whereas the distribution dividend in form of dividend that you receive from the REITs is not taxed. Then you have another component which we call return of capital. That again is taxed only by way of reduction of your acquisition price and not when you receive it. So these are instruments which are very tax efficient and give regular income to anyone owning it. So if you were to look at it, whether it's a right, I would say, allocation type in your portfolio, I think yes, because it gives you the right blend of regular income as well as capital appreciation.
Preeti, Chheda, will we be also seeing residential being a part of REITs, or is just going to be commercial?
So for residential REITs to happen in India, while they are very large asset classes in US when it comes to residential REITs, in India, as we spoke earlier in the conversation, today most of the people still in India prefer to own assets and actually renting. Residential REITs can happen when you have the rental models which are gaining traction. And secondly, your yield from those residential models have to be good. So today, if you look at residential yields, they are somewhere 3-4% or even lower. But for you to really make sense out of a REIT, your yields have to be really good, which is not the case today.
Right.
So unless the residential, I would say renting of residential market improves, it's difficult to actually see residential REITs in India. I'm sure it will happen a couple of years down the line, but today I don't think residential REITs are mature enough to get the space in the Indian REIT market.
Right, right. Ashwin, according to you, what should be done to for investors or retail investors to consider REITs as one of the main ways, or the primary ways of investing in real estate?
I think the start has been, I think the right start. So the structure's right, as Preeti was explaining. I think we've got the taxation right. We've got a good mix also in terms of commercial and retail availability of asset classes. I think what is missing is probably a lot more investor education, awareness for people that in terms of what it is happening. I think it also didn't help that last 2-3 years the office market was hobbled in terms of the COVID after effects, and I think going forward clearly we do see hopefully that some of this should start streamlining and people should start seeing the impact of a more BAU environment when they look at the holding period return. So one part is, I think, just the awareness and the fact that, when as these assets deliver what they're supposed to deliver over a period of time and people start experiencing this firsthand, I think that starts having its effect. The other
Preeti Gupta, less than 30 seconds. I'm sorry, my time is actually up, but I want to take a take from Preeti Gupta also. Less than 30 seconds, just your take on, for millennials and Gen Zs, the best way to invest in real estate.
Well, I think I'll just add on to what Ashwin just said. I think the one more piece is that it's democratized now. REITs are democratized, which allows every person to put in small amounts of money and get access before they go on to buy homes. So to me, the ideal way would be to start allocating some amounts of money in REITs, which are smaller amounts, so that you at least have your hedging your property inflation. And then as and when you're ready to buy a house, you go in and buy with your on payment, and whenever you're ready to take on PMIs.
All right, so it's been a wonderful knowledge session on the right ways to put money in real estate, whether buying a house or buying REITs. Thank you so much for three of you. My time is actually up, but then thank you so much for taking time out and helping our viewers with every aspect of investing in real estate. And for all our viewers, that will be all. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.